If you've paid any attention to the stock market lately, you've probably noticed that there have been quite a few down days over the last couple months. And if you own any companies that pay out dividends, you might be wondering what happens to those dividends during a market crash. And that's exactly what I'm going to talk about really quick here for you guys. So the good news about dividends is if there does happen to be a market crash or a market correction, a lot of the time those dividends aren't going to be affected because on an individual company basis, just because their share price goes down, it doesn't necessarily mean that the company's unhealthy and that they're going to have to resort to either a dividend cut or a reduction. So a lot of the time your dividends are safe even if you're seeing a ton of volatility in the market. But even if companies are healthy, there still is risk to the dividends if things are substantially changing in the market. Because for instance, if you look at Disney just a few years ago, when they had to shut their parks down, they did eventually have to cut their dividend because of different factors that were affecting the company. So therefore, even if you're going after a big company like Disney, and if they have a very good track record on their dividend payouts, circumstances can change drastically enough to where they have to make those changes to either cutting the dividend entirely, which is what Disney did, or they have to reduce it for a little while, and then hopefully it can go back up once things in the market change. And you should also know that if you own any large index funds, like let's say the S&P 500 index, if there is a market crash or a correction, those dividends are really not going to be affected because you're so well diversified under so many of those different companies inside the index. So if a few of those companies did have to cut their dividends, it's really not going to affect you as a whole because you have all those other companies still paying out those dividends inside the index fund. So if you do happen to own a lot of ETFs that are large index funds, then you're probably going to be really safe when it comes to those dividends, even if there's a huge correction in the market. And technically speaking, if the share price goes down, the dividend yield is always going to go up because it's directly tied to the share price. So if the share prices are low and you really feel that the company is a good value, then buy in when they're low because the dividend yield is going to be higher and you're going to get a better dividend payout on the money that you're investing because the share price is lower. So for example, if a company's share price was $100 a share with a current dividend yield of 5%, and then all of a sudden the share price went down to $50 a share, well, the yield is now going to go up to 10%. So in that case, if you started investing at $50 a share into that company, then you could expect a 10% yearly dividend return, which is excellent, especially when those companies are good and healthy, and you know that you can buy them at a really good point where they're a good value. Just remember that dividends aren't everything because the initial investment really does need to be going up over time if you want to do well in the stock market. But if there ever is a correction or a market crash, just know that if you're invested in good, healthy companies or large index funds, then those dividends are probably going to be pretty safe for you. Even though there is always risk, there's less risk associated with big, healthy companies, and you should always do your own research on those companies before you invest in them. And if you are new to the Robinhood app, definitely check them out because with Robinhood, you can invest in stocks, options, and ETFs, all with no commission fee. Sign up with my link in the description and get your first stock for free. Other fees and limitations apply. See the description for more information.